Welcome to this video from IFR for NPO, the last in our series addressing the proposals in INPAG Exposure Draft 2. In previous videos, we delved into the proposals on revenue, grant expenses, inventory, and foreign exchange. In this video, we'll briefly explore the remaining subjects in ED2 to demystify the proposals and stimulate valuable feedback from stakeholders. INPAG uses the IFRS for SMEs accounting standard as its foundational framework. Prioritized topics are reviewed in detail, to be modified or even newly developed. The remaining sections are considered for alignment, simple terminology updates, and potential removal. To be clear, these sections have not been reviewed in detail. We reviewed 8 of these other topics for Exposure Draft 2. These are financial instruments, provisions and contingencies, borrowing costs, share-based payments, employee benefits, income tax, hyperinflation, and events after the end of the reporting period. The most significant changes are to the sections on share-based payments and employee benefits. There are also alignment changes to financial instruments and provisions and contingencies. To ensure consistency, we've implemented common editorial changes across all sections. Firstly, terminology changes to use terms that are more specific to NPOs. For example, replacing entities with NPOs and replacing profit or loss with surplus or deficit. This is consistent with the terms used in the fully reviewed sections. Secondly, the names of some primary financial statements have been changed. INPAG proposes to have a statement of income and expenses, and a statement of changes in net assets, and to omit the statement of comprehensive income. All references to financial statements have been amended accordingly. Finally, there are some consequential changes arising from amendments to other sections. The concept of fund accounting stands out as the most significant. These editorial changes ensure alignment with the proposals in Exposure Drafts 1 and 2. Any later refinements or amendments to the proposals will be reflected across all topics in INPAG. There are a few sections, reviewed for ED2, where more substantial alignment changes are proposed, starting with share-based payments. In the IFRS for SMEs accounting standard, Section 26 specifies the accounting for all share-based payment transactions. This includes arrangements with employees or vendors, where shares are provided as part of a payment package. Based on our research, it is uncommon for NPOs to have share-based equity claims. The existence of tradable NPO shares, with commercial value, is expected to be extremely rare. This is because of the nature of NPOs. According to the characteristics set out in Exposure Draft 1, any surpluses must be used for the NPO's purpose, rather than being distributed for private benefit. It follows that NPOs are not expected to have equity that can be traded, with a value that is relevant to employees or suppliers. And this raises doubts about whether a section on share-based payments is relevant for NPOs. While guidance might be beneficial in theory, it could also create unnecessary complexity. For these reasons, no section on share-based payments is proposed to be included in INPAG. In cases where guidance is needed, there are provisions in the preface to INPAG about the steps to take regarding this or any other specific issue faced by an NPO. Section 28 on employee benefits covers all forms of consideration given to employees. A high-level review of this section identified some points relating to the likely types of remuneration arrangements that NPOs might have. References to share-based payments have been removed, for the same reasons mentioned earlier. Profit sharing is also not expected to be a form of remuneration for NPO staff, given the nature of NPOs. So all references to profit-sharing arrangements have also been removed. References to bonuses have been retained, as there may be reason for this to be part of a remuneration structure. Section 11 on financial instruments provides guidance on the treatment of financial assets and financial liabilities. Part 1 of this section addresses simpler financial instruments, such as cash, receivables, and payables. Part 2 addresses more complex financial instruments, such as those relating to hedging instruments and derivatives. References to share-based payments have been removed from this section, for the reasons mentioned earlier. The presentation of fair value adjustments to financial assets and financial liabilities has been amended to direct where they appear in the Statement of Income and Expenses, or Statement of Changes in Net Assets. The implementation guidance contains a new illustrative example that shows monetary assets and liabilities arising from grant arrangements. Section 21, Provisions and Contingencies, covers the definition of provisions, contingent assets, and contingent liabilities. It provides guidance on what needs to be recognized, approaches to measurement, and disclosures required. This section is particularly relevant because of its interaction with proposals on grants and donations. The implementation guidance shows examples to illustrate the key principles, including a new example relating to onerous grant agreements. INPAG Section 25 specifies the accounting for borrowing costs. Other than minor editorial changes, there are no further proposals. Section 29 addresses the accounting for income tax. While there are no material changes, there are 2 points to note. Firstly, INPAG introduces a requirement that tax expenses are recognized in the same primary financial statement as the transaction to which they relate. For example, if a tax expense related to a gain shown in the Statement of Changes in Net Assets, the tax element would also appear in the same statement. Secondly, an exclusion relating to government grants has been removed to reflect the changes in Section 23 Part 1 on revenue from grants and donations. Section 31 describes the requirements where an NPO is operating in a hyperinflationary economy. Other than minor editorial changes, there are no further proposals. Section 32 sets out the principles for recognizing, measuring, and disclosing events that happen after the end of the reporting period. References to profit sharing and dividends have been removed, consistent with proposals elsewhere in INPAG. The scope of the sources of bankruptcy has been widened to include grant providers. This reflects the potential importance of grant providers as a source of finance. Finally, the description of people with the power to amend the financial statements after they have been issued has been amended to reflect the nature of NPOs. This video sets out the proposal to remove guidance on share-based payments and to amend guidance on employee benefits to align with the characteristics of NPOs. The proposals include some additional NPO examples for financial instruments, as well as provisions and contingencies. Finally, there are some minor editorial amendments to a number of other sections that are included in ED2. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 15th of March, 2024.